This morning we have the pleasure of having with us Michael Drapac of Drapac Capital Partners. Michael, there's very few people anywhere in the market that understand conditions and property cycles like yourself. So let's get straight into it. What are you seeing on the ground at the moment?
There's just too much irrational positivity. And people say, oh, the market, Michael, gee, it's doing great, the market's doing great, the market's doing great. And then I start to challenge them. And I say, well, but have you really examined this carefully? Have you really examined, is it really doing well? There's certain sectors doing well. So I've really dug very deeply. I've gone and seen lots of agents. I'm not interested in dealing with tyre kickers. I'm dealing with people, talking to people, interrogating people who are on the ground, large volumes of property, large volumes of retail, speaking to lenders, big lenders, speaking with architects, and builders and large companies, and what I'm seeing is a very different story. And I've spoken to agents that handle large volumes of residential, and I'm starting to see the most uncertain market. The conditions are so uncertain. I've never seen such uncertainty. And and we could talk about it. I mean, what's the uncertainty of the virus, of the pandemic? The vaccine raises more questions than what it answers. There's now mutant strains. I heard the head of the AMA talk the other day, and he said, the virus is coming. Don't think he spoke on Friday on Radio National, do not think that we can continue a strategy of elimination. How finite, or what are the limitations of the vaccines? What impact is that going to have on the dynamics of the office environment? If you speak to people like Biss Oxford, he said every month we change our assumptions. 380,000 square metres of new space came on the market last year in Melbourne at a time when vacancies were starting to increase. I prefer to refer to it as occupancy. And every company you speak to, whatever assumptions they had in December, they're very different to today. What does that look like, right? What's the city of Melbourne CBD going to look like? What is occupancy going to really look like in 2 years from now? And working culture, in office culture, we don't know. I spoke to, I won't mention his name, a very big lender. He does a lot of the lending in Melbourne. And he said to me the other day, I had breakfast with him, with another banker, and they said LVRs for retail and offices were 65 pre-pandemic, 65 LVR, now they're 45. And he said, and we're calling on client after client after client to top up, because not only the LVRs tumbled, the values are tumbling, right? So if you had a vacant shop or had a retail lease on it, even if you had it fortunate enough to have a retail lease, you find that the values have now been repegged down by 25-30% on average. Two big valuers I've spoken to. Now you do the maths, right? Do the math. If you had a $20 million property before and you could borrow $13 million from the bank, and the property's now worth $15 million and you can only borrow 45%, you've got a $70 million cash shortfall. So I'm seeing things like that. I speak to architects and two very big firms, very busy, really busy, but no new work. I come to the conclusion that I think the entire property landscape is being reshaped. And we still don't know, there's so many things which we don't know. I mean, I mentioned the vaccine and the virus. We don't know what's really going to happen. Everyone's saying, oh, but the market's done so well in this pandemic. Hey, has it? We've been so numbed from the pain. We've all been on morphine, right? Interest rates lowest ever. JobKeeper, JobSeeker, insolvency moratoriums, mortgage moratoriums. Rent moratoriums. So everyone's been, and then I spoke to one of probably the biggest player in the residential market as an agent, and he said something really interesting to me. I had dinner with him. He said, our transactional volumes are down dramatically. I said, oh yeah? He said the buyers last year in 2020, who were buyers in February, March, April, May, he said they didn't go away, but no stock came on the market. And then with reduced interest rates and all these incentives, there are buyers which came on the market that ordinarily probably wouldn't have. baby boomers and people that ordinarily would have sold didn't want to sell. Who wants to sell in last year? So the people who are in the market couldn't get set. One, the agents weren't busy, weren't selling, and two, people weren't selling. And so the supply-demand equilibrium just got so destabilised and created this perception the market's booming on the back. But look at the transactional numbers, right? The end game there might be that the market will continue to improve. And I think good quality residential, and I said it a year ago, good quality residential won't be affected much at all. But then now let's look at apartments. I spoke to a guy who manages 4,400 residential apartments, and he said rents have dropped 20-25%, vacancies are over 10%. And then I spoke to the biggest seller of prestige apartments, and I said, oh, what do you think the upmarket, the residential, upmarket residential apartments are doing? He said, how much do you think they've dropped? He said, can't tell you. I said, what do you mean you can't tell me? He said, there's no market, no one's buying. I said, what do you mean no one's buying? And he said, well, those people are in the $2 million to $5 million price range, have options. And he said, they're not buying because they're frightened of being locked in a building, and so that's changed buyer appetite. And those buyers have gone and started to look for, townhomes, nice, upmarket, double-storey terrace homes, etc., etc. So that market's benefited. When everyone says to me, oh, the market's doing great, well, how, just again, logically, immigration's at a standstill, tourism's at a standstill, students have dropped off completely, and the market's doing well. There's got to be winners. There are winners, and the winners are obvious, but there's lots of losers, and I've only touched on some of them. So when I look at it, I think that I've never seen more uncertainty, and I think, and we go back and people say, oh, but there's lots of, I hear this all the time, this nonsense. They say, there's so much money in the system. Yeah, there is. And interest rates are so low. Okay, but confidence is so fragile, they forget that. They forget that the stock market collapsed 35-40% around the world in a low interest environment. When all this money was there, why did it collapse? Because confidence got wounded so dramatically. And the funny thing is, why did it collapse? Collapsed on the fear of COVID. COVID was realised, the fears of COVID were realised, and then the stock market came back to record highs. And outside of Australia as well. So, and then we look at this confidence thing, what happened in 2009? 2009, it was the GFC. Remember what the federal government issued, issued that they stated that we can only we'll give a guarantee of $1 million per bank account. The banks, the whole market, the whole world collapsed. Again, confidence is very fragile. In 2018, when we had the banking reports came out, and in 2018, I saw subdivisions which were selling 40 lots a month drop to zero, 1 or 2 a month. And so all I'm saying is that when there's a great saying, when the snow melts, the poop stinks. I think JobKeeper's coming in, job seekers coming in, the moratoriums are coming to an end. Valuers are now revaluing things. Banks are changing their LVRs. Insolvencies are starting to increase. I spoke to an agent yesterday. He said we've got 40 properties coming on the market. Just one agent, which are all insolvencies. Banks in mortgagee in possession. So, and one of the things I spoke about last time is that you only, I've never forgotten this. And when I did some research on the Sydney, Melbourne, Atlanta, Chicago, and New York office markets, you get a small shift in occupancy. You get an exponential shift in actual rental, in values. And you only need to track if the easiest one, the most transparent one to follow is the Sydney market. When you just see what happened between 1990 and 2020. Correlate, look at as occupancy or vacancy, whichever way you wish to express it, changed by 10-15%. Look at the exponential effect that had on the actual rental values. So I think that here, if we get already, I can see, I spoke to an agent's got 722 shops. And I asked him the question. I said, how much do you think rents have dropped? He said, there's a few isolated examples, exceptions, But generally, we did an analysis in our office, and face rents have dropped a third on average. But because incentives have increased dramatically, we think effective rents have dropped between 40 and 45%. The most telling thing he said, I think things are worsening. He said, we are managing, there are people in life support, metaphorically on life support. If we have another dislocation or another, lockdown, it doesn't even need to be prolonged, he said another 5 or 10% of our at least 5% are gone, they're finished. So for all those people that are very optimistic, I think you really need to, and I'm not, these are facts, I'm not speculating on these things. These are facts, these are objective facts. And I think that every day, when it comes to the virus, every day there's something new. Now the threat of Papua New Guinea, now the fear of, we heard in Europe last week that 4 countries had banned the AstraZeneca vaccine. If you ask the 2 top immunologists these questions and ask them, will the vaccine reduce transmissibility? The answer is we don't know. How long will it confer immunity for? Will it be years? Don't know. We may probably have to get a jab every year. Right? Will it confer immunity against these new mutant strains or these new variants? We don't know. And that's not a criticism of those guys. It's just another example of the unknown. And if you said, well, winter's coming, are we going to have further lockdowns in Melbourne? We don't know. So, and I think it's an opportunity for, one of the things you can be sure of, you just look at, as I said before, in 2005, we were in the middle of an economic boom. I know I keep harping about this, but land was as cheap as $1,200 a metre in the CBD of Melbourne. No one had any forward vision, very few did, some did. And all I'm saying is that I think the market is very prone. Commercial markets are very prone to irrational behaviour. Confidence is very fragile, and I'm already starting to see gaps, and I'll give you a good example. Once upon a, say pre-COVID, if you had 2 retail shops, and there's lots of examples of this, if shop A were the one that was tenanted and shop B was a shop which was vacant, but for all intents and purposes they were the same type of property, same street, same size, the differential between one and the other was virtually negligible. In other words, pre-COVID, had a shop, retail shop, vacant was worth $3 million, rented, let, it was worth probably $3 million. Very little difference. Today that differential, there's a real differential. If you have a vacant shop, a let shop, it might be worth $3 million, but a vacant shop is nearly half today. The sales, not quite half, I reckon 60%. So, and I think there's going to, for people that, as always that great man saying, when everyone's looking this way, you can't afford to look the same way as everyone else. You've got to look the other way. And I think that at the moment, those people are running around saying the market's going to be fine. I don't know on what basis. When is immigration going to return? When is interstate immigration going to return? When are the students really going to come back? So it just, to me, it doesn't make sense. And then you start to see, small clouds, black clouds on the interest rates. We've had an environment, we've had the biggest set of tailwinds in the history of the property market in Australia. Immigration, stimuli, lowering of interest rates. Those tailwinds that I said the last time we spoke have come to an end. Interest rates can't really go any lower. And if you actually monitor the interest rate at the moment, they kicked up from 0.15 to 0.35 or something the other day. And the 5 and 10 year rates, I think it was the 5 and 10 year rates, have actually kicked up by about 100 basis points. So just imagine, the government will never allow a situation where interest rates will go from 0.1 to 2 overnight, meaning the borrowing rate would go from 2 to 4. That's not going to happen in the short term, but it will happen over time. And so what's that going to look like in 3 or 4 years from now when the interest rates have kicked up, 100 or 200 basis points. But I'm an opportunist, unashamedly, but at no expense to anyone else. But I'm very optimistic about going forward. I think, immigration will return. I think Australia is going to be one of the most desirable places more than ever before for people to emigrate to. But the whole market, 2 years ago, to use an analogy, you drive down the freeway and there was one speed. They were all going the one speed. Apartments, retail was a little bit slower, but offices, logistics, industrial, residential subdivisions, everything was flying along. Today you go down the highway, it's fascinating to watch, metaphorically. This car's broken down, the retails are broken down on the side of the road. You're seeing, seeing the office blocks being towed by a truck. And then you see this red Ferrari go flying past and saying, "Hey, I'm the coastal market," and then you see, a blue Porsche go by saying, "I'm the regional market." But so that's all got to play out. That's all I think I like to refer to as the Great Unravelling is about to happen, and the reshaping of the market and the recalibration of the market. And people are going to overreact, and there's going to be great opportunities. And I've already seen, haven't seen it in Melbourne so much, but I've seen opportunities in other areas, in other states where, there's been great sites that are on the market and been able to be bought at the right price.
And sticking on that automotive thing, given you've raised it, you've people that know you would have heard this saying before, but you look at the market with 2 feet on the brake and one hand on the accelerator. Where are you at with that today?
It's a phrase, my favourite phrase about, when someone says, "What are you doing?" I said, 2 feet on the brake and one hand on the accelerator. Well, at the moment I've got, 2 feet on the brake, 2 hands on the brake, and my little nose is on the accelerator just sniffing, right? But I'm excited in terms of if you can be patient and have courage and understand property, I think there's going to be some good opportunities emerge. But the risk profile is all wrong. Someone said to me, "Well, explain to you what you mean, Michael." I said, "Well, it's like going to the casino. At the moment, going to the casino and you want to back black, meaning black is a substitute. I want to buy, I want to invest in the market. Well, if you went to the casino and there were only 6 black numbers and 30 reds, and you're only going to get a dollar profit for every dollar you invested, if black came up, the odds aren't too good. Black might still prevail, but I'm not so sure. The odds are just wrong. The probability, the downside probability is too high, and I don't see a lot of upside. Clever investing is optimizing your risk-reward equation. It's not about some, "So I made 10 times my money on this fly-by-night, stock." Yeah, but 5 other companies lost my money. It's property investing, and investing is about risk-reward. The risk-reward is that equation or that expression is wrong at the moment. It's so out of balance. There's very little risk, very little reward, and an enormous amount of risk. And I just think let that unravel, and I think it'll be a good time to invest somewhere in the next. I've made a few offers on things, but they're very unfashionable, and I'm looking where no one's looking.
And let's talk about development site values. You've seen almost every site across Melbourne over the last couple of months. Where are you seeing opportunities and where are you avoiding?
At the moment, I think Melbourne is fully overpriced. I mean, I was with an agent Wednesday. I was with an agent yesterday and Wednesday, sorry, and I just said, "What have you got for sale?" And and it was all overpriced. I said, "How can you justify $15,000 a metre there?" I said, "Who's going to develop that today?" So what I'm avoiding, I'm not really a developer. I mean, I have developed a few things. I'm very poor at it. It's not my skill set really. But I just don't see, if you go and buy, someone said to me the other day, I'll give you a good example. He said, property out in the suburbs, $29 million. And I said, okay. And he was asking me my opinion about someone lending first mortgage of an LVR of about 55%. And to answer your question, I said, well, what's the end value of that project? So the end value was about 200 million. So you've got a $29 million land component, end value is $200 million. And I said to the lender, I said, can you see the end value dropping from 200 to 180? He said, yeah, no, easily. I said, well, what's your land worth then? And he said, he looked at me and he said, well, it's probably going to be worth 10% less. And I said, no, it'll be worth 10 million. What I've been looking at is, I've been looking at some rural land, and I've been looking at, I've made an offer on a couple of things interstate. So I'm not looking at anything really in Melbourne. I'm nothing at the moment, but I'm very keen to monitor it. So I'm out and about looking every day, not every day, 2 or 3 days a week, and just watching how it unfolds. I do think some of the winners will be, the obvious is coastal markets and regional markets, but I think that neighbourhood retail is going to hold on well, because I think destination retail will really suffer. I think retail in the city will suffer, office space in the city will suffer, but I think suburban retail sites, suburban office sites will do really well. And so I'm very confident about that. But I just see, and my comments I'm not levelling these comments in the Sydney market. I think Sydney is a unique beast, and I don't know enough about Sydney to make a comment about. But I think the comments that I'm making apply to every other city in Australia except Sydney. I think Sydney is a unique beast. You only have to see how people like Harry Triguboff are responding to this. It's a very different market, and it's a very unique city. And I think the sad thing about COVID for us is that if someone contemplated that or had a view that Sydney and Melbourne were not too far apart, I think Sydney has just gone ahead in leaps and bounds because of the way they've managed the COVID response. And I think Melbourne's really going to suffer from it. I think, Rob, when you're saying where are the opportunities, it's cliched. Sometimes, if you look at Buffett, and not just Buffett, but Ray Dalio and many others, the opportunity is just to sit sometimes, and be patient and wait till the risk profile is right. Something I looked at the other day in Adelaide and Perth, really, really two of the best high-rise sites in the city, and not having to pay $1 premium for the blue sky. So if someone says, why would you want to go to Adelaide, or why would you want to go to Perth? Well, if you've got a view that they're going to develop high-rise there again, well, if that's your view, it is my view, might not be for 5 years. Well, at the moment, because no one's doing any high-rise there, you're able to buy sites which ordinarily you wouldn't be able to buy. And providing you can buy them at a price point where you haven't paid $1 premium for the blue sky, and they perform as an investment along the journey, why wouldn't you? The risk profile's right. So they turn around and say, oh, Michael, you got it wrong, and they're never going to develop high-rise in Adelaide again. Well, okay, you might be right, mate, I was wrong. But I haven't taken a risk because I bought it on at 5.5%, 6% return, and it's a good asset. And that's what we did in America. We did in Chicago, we did in Atlanta, and we did it in the Carolinas, we did in Miami, just to be able to buy important sites and not having to pay $1 premium for the blue sky. They've all come good, and that's what we did extensively in Melbourne, not just in the CBD, but in the suburbs of Melbourne in the early 2000s. But I think the opportunity is just sit and watch. I think, spoke to a really smart guy the other day who's got a very, very big pile of money, and he said, I'm going to buy apartments. And I said, I was waiting for your reaction, Michael. He said, because I think they're going to drop by half. He said, but I might have to buy 100 at a time. And I said, I like it. There was a great guy. His name was, ran a company called Trinity Investments, Lindsay Shattuck. And he was he's probably a lot of people, the older people would remember him. And he used to buy apartments from the 60s, 70s, 80s, and he had a very simple formula. He used to wait till they dropped to below replacement cost, and he was very successful. And I think that if there is, some of the apartments, if it gets as bad as I think it may get, there might be some big wholesale opportunities. But sit and watch, and I'm sure as things unravel, and the snow melts, and the real mortgage distresses start to happen, I think there'll be opportunities will emerge.
What about from a funding environment perspective, whether it's from non-bank lenders or investors in your own businesses? How are you finding appetite and sentiment?
Most people that probably about half of what I do is on my own balance sheet, but there's a lot of money out there. There's a lot of silly money, and there's a lot of very smart money. And I speak to a lot of people. There's a lot of money there looking for a home, but the guys I speak to, most of them are very patient, and they're not in a hurry. 3 or 4 blokes I know, 3 or 4 families I know have got several hundred million each, but they're patient. They're just sitting and watching. But there's a lot of people there that are going to hurt. A lot of people. But you've got to look beyond the obvious. You've got to look beyond the obvious. I can't mention a deal a mate of mine's doing, but he did an amazing deal. It's a $100 million play in this climate, and he looked where no one was looking. And I think he'll double his money very quickly. I'd say he'll double it within a year or two. But he was, buying assets which no one was looking at. I wish I had been looking at it, but I wasn't.
What ratios do you look at or analyse? You mentioned risk-reward equation earlier. What else do you look at in your analysis?
I think for me, I've done over 200 deals in my life. I've only ever lost on 2 of them, 2 that I can remember. But it's a long time since I lost on a deal. But if you buy broadacre land, and even when I bought a lot of broadacre land in Melbourne, we bought about 11 or 1,200 acres. We bought it at a time when we're able to buy rezoned residential land at $5,000-7,000 an acre. So that's never going to happen again, not in my lifetime. But the downside was zero because I paid farming values, and that's what we did in the US. We bought about over 15,000 acres of residential land at prices in that $5,000 range. So your downside was zero. If I were to buy, it's really just looking at what's your risk profile. Because if people say, like if you're buying a retail, like someone the other day bought a shop and they paid 5.6, I didn't go to the auction, but I followed the auction online. They paid $5.6 million and it was leased to the Commonwealth Bank. And I thought, my God, I said, 5 years' time, the bank won't even be there. The banks are closing down branches, as you know. And if that happens, there's 20% vacancy in the street, that the risk profile of that is just wrong. Whereas if I'd rather buy a shop which was vacant, frankly, which assumed the worst. And I'll give you a good example. I saw a shop sell the other day, and it sold very low ones. You could convert it to a residence. Right, so if I was to buy a retail, always what's my get out of jail card? What's plan A, plan B, plan C? So it's always just asking if your primary assumption is wrong, on which predicates you buying it. What's your safety net? What's the B plan? What's the C plan? And I think smart developers, they do it differently. And I don't consider myself a developer. I've always told you that they won't proceed with a project until they've got X number of pre-sales, even if they've got the money. Smart developers won't. In Melbourne, Harry Triggerboff is different because he's in a world. He's in his own universe. That man. But generally speaking, a smart developer won't go and do anything will just measure his risk. He'll recalibrate his risk. And people say, I've got 60 apartments sold off the plan. Well, how strong are those contracts? So it's just about, going back to what I was saying before, 1 foot on the, 2 feet on the brakes, 1 hand on the accelerator, always looking at your risk profile. A mate of mine's a very clever share investor, and he he has a several $100 million portfolio, but he doesn't do as well as some others. But I can tell you, he doesn't lose. You know, he counts. You know, he does have some losing stocks. Of course, everyone does. But he said it's all about the risk profile. And so for me, I would say clever property investing is about understanding that risk profile. And you know, like if you buy, you know, a very simple one, which every property investor would know. If you buy a property and it's got a lease, I mean, the first question you ask, well, assume that that tenant goes bust tomorrow, am I going to be able to release it at the same price? And in this market, I'd say, well, you've got a tenant, you buy a retail shop, it's got a lease, well, you know, assume that you're going to be able to lease it again at 60% or 70% of what it previously was. That's what I'd call risk management. It doesn't mean, it means you look a lot harder, you study the market a lot harder, you tend to ignore what a lot of other people say, and you've got to be super patient.
You mentioned earlier around about 2005 square metre rates in Melbourne CBD, I think were around 1,200 per square metre. What's your reading on where they're at today, and is that sort of growth sustainable long term?
The cheapest site I bought in 2005 was 1,200 a metre. The dearest site we paid was 2,300 a metre. And I remember we paid 2,000 a metre in William Street for a big site. People were mumbling that, you know, I'd lost the plot and paid too much, ridiculous amount of money. But that is a function, Rob. I mean, at that time, no one was developing. But that is a function. Land values, and any developer knows the actual raw land value is a function of what the end value is. So to answer your question, is it sustainable? I don't think so. Because one thing that I don't think anyone would argue is this: is the city landscape going to be the same going forward? Are we going to have a different city landscape going forward? We will. No one has a perfect crystal ball to envisage what that's going to be. But it is going to be a different city landscape. There's no doubt about that. We're going to, you know, apartments are not going to be occupied as much as they were. You know, office buildings are not going to be occupied as they were or function as they were. The dynamics will change. So if you said that land today was 15 to 20,000 a metre, and you said, so, you know, 2,000 square metre site, 20,000 metres, $40 million, and you said, well, that as a function of its end value is $40 million fully developed becomes $300 million. That's your equation. So prior to the pandemic, that's more or less what the equation looked like. A $40 million site was developed and became a $300 million end value building. Go back to what I said just a little bit earlier. If the end values change, in other words, if the demand for apartments drops a little bit, if the demand for office building drops a little bit, and it only has to drop a little bit, if those end values decrease by 15%, so the end value, the $300 million building is now 255, well, you know what's going to happen to the land, don't you? It'll drop by 75, 80%. People don't want to hear this, but they only need to see what happened in the 80s and the 90s and the 2000s in Melbourne, and even in Sydney to a point. So when you say is it sustainable, I don't think it is sustainable. There will be exceptions. And what I want to highlight is the fragility of that equation. That mathematical equation is that just to think where land was in the 1990s, what it was in 2005, the equation is it was only 2,000 metre maximum because the end value was quite low, the end values doubled, the land prices went up tenfold. It's not sustainable because I don't think anyone would disagree that we might see end values. We might see apartments drop from 12,000 metre to 10,000 metre. We might see, you know, office buildings drop from, you know, by 20%. If that happens, particularly in the CBD and the inner CBD, as I said, I keep saying Sydney's a different world. But again, the banks, as I spoke to the lenders, two bankers this week, you know, there's the loans are being reviewed now. You know, the party's over, and so I don't think they're sustainable. Am I saying that there's not going to be development going forward? No, absolutely not. There's going to be development going forward. They're going to build high-rise again. They're going to build apartments again. But at the current price points, I don't think so. And I think in the short term, there's going to be a lot of pain. And and the red Ferrari and the blue Porsche will continue to rock down the highway, but you're going to see more broken down cars and cars being towed than previously. It's not a one speed highway anymore. It's a five speed highway. There's the broken down lane and there's the 20-kilometre lane, etc. So I'm excited about it because we're in a very good position, and I'm really I'm not going to prey on anyone's misfortune, but I buy and sell assets, and I hope no one really suffers over it. But I'll wait till the market corrects and I see opportunity, whether it's in Melbourne or whether it's in interstate or even it's overseas.
In terms of market distress, just to finish up on, are you seeing any signs of market distress now, or do you think it'll come in the next 6 to 12 months?
It's definitely starting to show up, but the banks, the lenders and the banks and just the entire financial system have had the brakes on. They haven't pressed the trigger, and they're starting to pull the trigger. And when you look at, I looked at something the other day. I mean, it was worth 40 million. They won't get 20. They'll get 20 for it. And the mortgagee is in possession and it will sell. And so I think what we're going to see now as all the painkillers wear off, and and the banks are going to bite the bullet, you've got to get that sold. There are a lot of people, there are a lot of assets. I mean if you go back, talking to the agents that I spoke to, they've got 140 something retail shops vacant, and effective rents have dropped by 45%. I mean, a lot of those are investors. A lot of those have got loans with the bank. I mean, they're going to have to sell some of those. Some won't need to. So we haven't seen this. We haven't seen the market forced into liquidation. The market hasn't. We've all been insulated from the pain. So we're now going back to normal commercial world. The JobKeeper and all those incentives. Painkillers are wearing off. We now need to go back to normal commercial world, a normal commercial world. But in the face of uncertainty, in the face of the vaccine, in the face of the growing, the pandemic continuing, and immigration immigration numbers not being restored, etc. So in the face of great uncertainty, the risk environment is just wrong. It makes no commercial sense. That's how I'm reading it, and I've got my little formula that works for me, and people ask me my opinion, I give to them, and you've asked me to speak again, so I thought I'd share my views with you.
Michael, it's been an absolute pleasure having you on this morning. The insights that nobody else seems to talk about. Thanks again for your time.
My pleasure, Rob. Thank you.